When most people see a bank, they see an ATM or mobile app, even somewhere to store cash. But in reality, it's a regulated balance sheet business that connects people who save money and lend money. And somewhere between that, there's a mobile system or payment system, as you can consider. This is how usually banks works. Think of a bank as a bridge with a security checkpoint, alright? The bridge that moves money through the economy between saving, lending, alright? And that the checkpoint decides who may cross, how much they carry, and how much they lend. If something goes wrong, they may intervene. Here are simple individuals and banks' balance sheet. Your deposit is your asset, right? It's simple. But your deposit is bank's liability because the banks owe you your money. A loan is opposite. It is the borrower's liability. It's simple. It makes sense, right? But it is the bank's asset. Why? Because the borrower owes the bank. Therefore, it is located in bank's balance sheet. Banks fund themselves mainly through customer deposit plus shareholder equity and market borrowing. They use that funding to hold cash, securities, and loans. Lending can also create a matching deposit in a banking system. So the childish explanation that banks merely pass one another exact cash up to another is useful, but it is really incomplete. The first income engine is the net interest income, or simply interest earned on loans and securities minus pretty much interest paid on deposit and other funding. The net interest margin, or NIM, compares that net interest income with the bank average interest subtracted by net earning assets. The second engine is the non-interest income. Payment fees, card fees, trade funding costs, a wealth management fee, and others count as a cost for their profit. Banks still pay off their staff and technology costs and must recognize some credit losses from customers who may not repay their loans. And after you subtract those things with the net interest earned at the start, you get their profit. A bank also manages several risks at once. Credit risk is the first one. It is where a chance of a borrower does not repay their loans. It's pretty straightforward, right? But the rest is not really simple. The liquidity risk is the danger that the bank cannot meet withdrawals or payment on their time. And the next one is interest rate risk. The risk comes from the assets and funding repricing movement. The next one is foreign exchange risk. You may have heard it several times. It is the risk that comes from currency movement. The next one is operational risk. It includes fraud, cyber attacks, broken processes, and human error. The bank kind of simply chase the highest loan rate. It might seem so, but it's really not. A 15% loan that is never repaid is not a brilliant investment in reality. It is an expensive piece of fiction. Retail, commercial, corporate, private, and investment banking serve different purposes and also customers, but all sit around the same question. How can this institution move money and earn a return without running out of liquidity, capital, or even trust? In Banking 101, we will follow one company through that machine.